In 2026, artificial intelligence has become the center of the stock market. Nvidia is raising billions through the bond market. Big tech is spending hundreds of billions on AI infrastructure. OpenAI is reportedly preparing for a possible trillion-dollar IPO. SpaceX has already made one of the biggest public market debuts in history. And yet, beneath the excitement, cracks are starting to appear. In early June 2026, a semiconductor sell-off erased roughly $1.3 trillion in market value from US-traded chip stocks. Nvidia, AMD, Micron, and other AI-linked names were hit hard after investors realized that even strong companies can disappoint when expectations become too extreme. So the question is simple: are we witnessing the beginning of the greatest technology revolution since the internet? Or are investors making the same mistake they made in 1999? The biggest misunderstanding about bubbles is that people think they are always built on fake ideas. But the dot-com bubble was not built around fake technology. The internet was real. It changed the world. It created Amazon, Google, Netflix, Meta, cloud computing, online banking, online shopping, and the entire digital economy. The problem was not the technology. The problem was the price investors were willing to pay for the technology. In 1999, investors did not ask whether a company had profits. They asked whether it had a website. Today, the modern version of that question is, does it have AI? That phrase alone has become enough to raise capital, excite investors, justify massive spending, and push valuations higher. But history teaches an uncomfortable lesson. A technology can be revolutionary, and the stocks attached to that technology can still be wildly overpriced. AI is no longer a small corner of the market. It has become one of the main engines holding up the entire financial system. AI-related companies now represent a massive share of the S&P 500's value. That means even investors who think they are diversified through index funds may still be heavily exposed to one single theme: artificial intelligence. And that is where things become dangerous. When one theme drives more and more of the market, investors stop owning a broad economy. They start owning a single story. That story says AI spending will keep rising. Data centers will keep expanding. Chip demand will remain strong. Corporate adoption will accelerate. Margins will stay high. And the winners will justify today's valuations through years of flawless growth. Maybe that happens. But if the story changes even slightly, the entire market can feel it. That is the risk of concentration. Not because the companies are weak, but because expectations are so high. Nvidia is not a meme stock. It is not an empty shell. It is one of the most important companies in the world. Its chips power the AI models that every major company is trying to build. Its data center business has exploded. Its revenue and cash flow have grown at a pace that almost no large company has ever matched. That is extraordinary. But even extraordinary businesses can become risky investments when expectations get too extreme. In June 2026, Nvidia announced a $25 billion corporate bond sale, its first major bond market deal in 5 years. Investor demand was reportedly far higher than the offering size. That does not mean Nvidia is in trouble, but it does show how large and financialized the AI buildout has become. Even the strongest AI company in the world is now part of a broader capital markets machine involving bonds, infrastructure, supplier commitments, private investments, and expectations of non-stop growth. Nvidia may continue to win, but investors should still ask one question: how much future success is already priced in? AI is not just software. AI is electricity, land, chips, servers, cooling systems, networking equipment, fiber, real estate, and debt. This is where the story becomes much bigger than Nvidia. Big tech companies are spending hundreds of billions of dollars on AI infrastructure. Data centers are being built at an industrial scale. Companies are racing to secure power, chips, cloud capacity, and talent. For years, the largest technology companies were famous for printing cash, buying back stock, and strengthening their balance sheets. Now, the AI race is pushing them to spend more, borrow more, and commit more capital to infrastructure that may take years to fully pay off. This is one of the biggest differences between the AI boom and the old software boom. Software can scale with relatively little physical infrastructure. AI requires an industrial buildout. And industrial buildouts are expensive. The more expensive the buildout becomes, the more future profits investors need to justify today's prices. OpenAI may be the most important private company in the AI boom. It created the product that brought generative AI into the mainstream. ChatGPT changed how millions of people think about search, work, coding, writing, and automation. But the business model is still being tested at enormous scale. OpenAI is reportedly generating billions in revenue, but also spending billions on compute, infrastructure, research, and talent. The company is also reportedly preparing for a possible US IPO that could value it at up to $1 trillion. Think about that. A company can be changing the world and still face a brutal financial question. Can revenue grow faster than compute costs, talent costs, infrastructure costs, and model training costs? This is where the AI story becomes less simple. Consumer adoption is real. Enterprise adoption is real. But profitability at trillion-dollar scale is not automatic. And if investors start treating every AI company as if future profits are guaranteed, they may be repeating one of the oldest mistakes in market history. Then there is SpaceX. SpaceX is not just a space company anymore. After its IPO, it became a symbol of the new mega-IPO era. Rockets, satellites, AI, internet infrastructure, data centers, and Elon Musk all wrapped into one public market story. SpaceX reportedly raised more than $80 billion through its IPO process and reached a valuation above $2 trillion. That is historic. But history does not make something cheap. Before the IPO, some analysts estimated SpaceX's fair value far below the public market valuation. Their warning was simple: SpaceX is an incredible company, but the stock may already be pricing in years of flawless execution. This is exactly how speculative markets behave. At first, the story is irresistible. Then investors begin asking whether the price can be justified. A great company can still become a dangerous investment if the valuation assumes perfection. The speculation around SpaceX did not stop with the stock. After the IPO, options trading exploded. Traders rushed into call options, betting that the stock would keep rising. That matters because options can intensify short-term stock moves. When traders buy large amounts of call options, market makers may need to buy the underlying shares to hedge their exposure. That buying can push the stock up. The rising stock price attracts more attention. More attention attracts more buyers. More buyers create more momentum. And suddenly, the stock looks unstoppable. But the same mechanism can work in reverse. When momentum fades, the buying pressure disappears. Volatility rises. Early investors may take profits. Retail traders who arrived late can be left holding the risk. This does not mean SpaceX is a bad company. It means the market structure around the stock can become dangerous. The business can be innovative. The stock can still be speculative. Both things can be true at the same time. This is why the 1999 comparison matters. The dot-com bubble was not a story about people being wrong that the internet would matter. They were right. They were just early, emotional, and careless about valuation. Many companies with .com in their name raised money despite weak business models. Investors rewarded growth stories over profits. Analysts talked about addressable markets instead of cash flows. Retail traders rushed in because prices kept going up. Does any of that sound familiar? Today, the words have changed. Instead of internet, we say AI. Instead of eyeballs, we say compute. Instead of website traffic, we say model usage. Instead of new economy, we say AI industrial revolution. Some of this may be justified, but the psychology is very similar. Investors are not just buying companies, they are buying a future. And the further into the future the profits are, the easier it becomes to overpay. Cisco is one of the clearest lessons from the dot-com era. Cisco was not a fraud. It was not a useless business. It was a real company selling real networking equipment into a real internet buildout. But investors paid too much. At the peak of the dot-com bubble, the market priced Cisco as if it would dominate the future without interruption. And while the business continued to matter, the stock price collapsed when expectations reset. This is the difference between a company and its stock. A company can keep growing. A stock can still fall if the valuation was too optimistic. That lesson applies directly to AI. Nvidia can remain dominant. OpenAI can keep changing software. SpaceX can keep launching rockets. Microsoft, Amazon, Meta, and Alphabet can keep building AI infrastructure. But if investors overpay, future returns can still disappoint. The question is not whether AI matters. The question is whether today's prices already assume too much of tomorrow's success. One of the biggest risks in the AI boom is that the ecosystem is becoming deeply interconnected. Chip companies invest in AI startups. Cloud companies provide compute to AI startups. AI startups use that compute to grow revenue. Public companies record gains from private AI investments. Investors see rising valuations and assume the whole system is stronger. But if too much of the growth depends on circular spending, vendor financing, optimistic accounting, and unrealized private market gains, then the system can look healthier than it really is. That is not automatically a crisis, but it is a warning sign. When the market is booming, complexity looks like innovation. When the market turns, complexity can become risk. And that is why investors should look beyond the headlines and ask where the actual cash flow is coming from. So, what could actually pop the AI bubble? It may not require one dramatic event. It could be something simple. A major AI company misses earnings. Data center spending slows. Corporate customers decide AI tools are useful, but not worth the current price. Power constraints delay new infrastructure. Regulators tighten rules around data, safety, copyright, or antitrust. Interest rates stay higher for longer. Or investors simply realize that the future may still be bright, but not bright enough to justify the prices they paid. That is how bubbles often turn. Not because the story becomes false overnight, but because the market stops believing the most optimistic version of the story. Once that happens, valuation matters again. Cash flow matters again. Balance sheets matter again. And suddenly the same investors who said price did not matter start asking why they paid so much. To be clear, this is not a prediction that AI will fail. AI could become one of the most important technologies in history. It may improve medicine, software development, logistics, manufacturing, education, finance, robotics, and scientific research. Some companies will create enormous value. Some investors will make a lot of money. And unlike many dot-com companies, today's AI leaders often have real revenue, real customers, and real balance sheets. That is why this debate is complicated. This may not be a fake boom. It may be a real boom with bubble-like pockets. And that is the most dangerous kind. Because the technology is real enough to make investors ignore valuation. The best bubbles are not built on total lies. They are built on powerful truths taken too far. So, how should investors think about the AI boom? Start with one rule. Do not confuse a great product with a great investment. Ask whether the company converts revenue into free cash flow. Ask whether customers are paying because the product is essential or because everyone is experimenting. Ask whether the valuation assumes realistic growth or years of perfection. Ask how much debt and future spending is required to keep the story alive. Ask what happens if growth slows. And most importantly, ask whether you have a margin of safety. Warren Buffett's lesson still applies. A wonderful business can become a poor investment at the wrong price. Peter Lynch's lesson also applies. Know what you own. Not the story, not the hype, not the ticker symbol. The actual business. So, is AI the next dot-com bubble? The honest answer is, maybe partly. AI is real. The spending is real. The revenue is real. But so are the risks. Market concentration is rising. Infrastructure costs are exploding. Private valuations are stretching. Mega-IPOs are attracting retail excitement. Options trading is amplifying speculation. And some of the biggest companies in the world are now tied to one enormous assumption, that AI will grow fast enough to justify everything being spent today. That might happen, But if it does not, investors could learn the same lesson the market learned after 1999. The future can be right, and the price can still be wrong. So before buying into the AI trade, ask yourself one question. Am I investing based on cash flows and valuation? Or am I just hoping someone else will pay more later? Comment below with your view. Bubble, balanced, or boom? And if you want more finance deep dives like this, subscribe. This video is for education and commentary only. It is not financial advice.